The Reserve Bank of India has put out its annual monetary policy for the financial year 2011. Key policy rates, the repo rate, the reverse repo rate, and the cash reserve ratio raised by a quarter percentage point each, pretty much what the market had factored in. But given that inflation, as the central bank has said, is becoming a huge concern for it, the big question is, why did the Reserve Bank hold back and raise rates by only a quarter percentage point? And to answer that, of course, we've got with us the Deputy Governor of the Central Bank, Dr. Subir Gokarn. Dr. Gokarn, now, the big question everyone's asking is, if the central bank did say that inflation is going to be a raging concern, or going to be a big concern going ahead, why did it hold back and actually raise rates only by quarter percentage point? Why not by maybe half a percentage point?
Well, I think people have to are focusing very sharply on the headline inflation, which came in at the WPI number, which came in at 9.9 for March. We've said often that RBI actions, monetary policy actions, are not a very effective tool against supply-side inflation. Inflation that is driven by increases in the prices of food and energy and so on. It's a much more effective instrument when dealing with demand side. Pressures that are coming from capacity being stretched, demand growing. Now, the recovery is clearly in place. We're far more confident about the robustness of the recovery now than we were even, say, 3 months ago. So what that is doing is starting to put some pressure on capacities. And as a result of that, we're starting to see the pressures on inflation shift from predominantly food a few months ago to now pressures coming from the demand side as capacities start to get stretched. So the number we took a careful look at was the non-food manufactured goods inflation rate. And that has gone from a minus 0.4 in November of 2009 to a 4.7% annual rate of increase in March 2010. So that is really the trajectory which we are directly addressing through our rate actions. It is not as dramatic a move as the 9.9% number would suggest, but it is clearly indicative of what we call the balance of risks shifting from the slowdown to now demand-driven inflation pressures. So given that swing, we think our responses are entirely appropriate. If you were to judge it in terms of the 9.9%, which is the more vivid number, obviously there is a concern that we didn't act either fast enough or strongly enough. But I think the meaningful number to look at here, that's important clearly, but there's a lot of food in that. Food prices are starting to moderate. We saw the CPI numbers come in today for agriculture and rural laborers, 1 percentage point below the previous month's numbers. That suggests that food prices are starting to moderate. But at the same time, these demand pressures are building up, and that's really what we're trying to address through this. We didn't want to be disruptive. We think the recovery is nicely picking up, but could have been disrupted by a sharper increase. So we wanted to maintain this sort of our approach is calibration, non-disruptiveness. That's really what we're trying to do.